Hi guys, right, this is video 4. We are just continuing to look at a few more sort of relevant costs here that we need to think about. So we'll just go through them briefly, and until you do a question, you'll sort of see how they are sort of connected, so to speak, or used. So let's talk about this one. Talks about provisions for future costs, typically for well, any sort of if you like, expenses that you have to sort of put in place for typical IFRS prudence, really, if you like, if you have to sort of any provision costs that are to do with trade, if you like. So classic, if you have to provide some kind of insurance, if you like, based on past experience. Nothing so different from our general idea of provision for doubtful debts, that sort of thing. Here's one, compensation for the loss of an employee. Yes, you're allowed to. Well, of course, again, if it's the idea is always to do with trade. Always to do with trade. If you have to pay more redundancy fee, and it tells you on the cessation of trade, and it has to be if it's 3 times more than the statutory amount. I've never seen this one before, but it's just that you know about it. They would have to give you the statutory amount, to be fair. But I think this is just for more knowledge. Counselling services, damages. Classic one that comes up a lot are these fines, and they say something like the director or the main owner of the business has parked and incurred some parking fines. Those are not allowed. Only parking fines by the employee. That's typical. Educational courses, of course, if for trading purposes. And this always creates some kind of debate, but it has to be for the purposes of what it is you're doing for trade. So maybe courses, if you were a technician or a plumber, if you're taking those courses, yes, those can't be put through trading courses. Of course, pension contributions, of course, the registered pension scheme, well, yes, that sort of makes sense. And you can't, of course, you can't allow bribes. Sometimes I always wonder why some of these are there. You can't put through a bribe as an expense. No, so that's kind of there straight away. Again, like I say, until you do a question, then you will see how that works. So please, and a couple more premiums for insurance, removal expenses, and finally salaries accrued, if you like, at the year end. So paid not more than 9 months. So sometimes you might have a backlog of salaries to pay. But this, you see, the thing is, all of this is coming from case law. So you can see with tax, it's not enough to see what new additions the government is allowing for as allowable expenses. So please do TYU3 as homework, and then let us carry on. Great. So we always have the scenario, and I'll just do the double entry of it very quickly. This is very popular, to be fair. So, for example, it's quite possible that a trader could buy some goods for £10,000, right? Now, if he's bought the goods for £10,000, from a tax point of view, if he takes half of these goods for himself, 5,000, the assumption is that he sold the goods to himself. So, if he takes 5,000 for himself, well, we're simply recognizing, yes, that he has purchased 5,000. Well, he bought 5,000. It's fine for the 5,000 to remain within purchases, but he must recognize it as a sale to himself. So if the 10,000 is, let's just take the whole 10,000. If he buys £10,000 worth of goods, and the £10,000 worth of goods are recognized in the income statement as purchases, and he takes them for himself, he must recognize the revenue at the markup. So say the markup was say 10%. So he must recognize the revenue at 11,000. So this is already in the system. He has to put through a journal of 11,000. So technically debit drawings and credit revenue. If he hadn't recognized this, if he hadn't recognized the purchase costs in the income statement, then what he literally has to then do, if he hasn't put it through yet, because that's possible, he might not have put it through his journal through, he has to recognize the profit, if you like, of just the 1,000 in his, if you like, because it's still the difference. I mean, the difference between revenue and purchases is 1,000. So we must recognize the 1,000. Or go in, put the 10, put the 11, and automatically the 1 falls out. So it's up to you how you do it. The key point is we must see retained earnings end up with 1, whether you do it via the actual physical input of both, or you just put through the difference. And that's what's kind of happening here. Yes, that's what's exactly happening here. So let's look. So I've sort of spoken about that already, but then let's look at, I think on the next page they do something of an example. So here we have goods for your own use. So you have a car dealer removes a vehicle from the business for his own personal use, and it originally cost the business 10,000 and had a market value. Need to reflect this other than the initial transaction. So really, the transaction we need to be doing is credit revenue with 12,500. So in effect, we end up deducting the 10,000 cost from the 12,500 to recognize that profit. So what are they telling us? Tax-adjusted profit must reflect the transaction if the owner has sold the vehicle. Yes. In determining the adjustment required, it's important to identify the entries made. In this example, only the original costs have been recorded. Therefore, the adjustment is to add the market value to the accounting profit. If the removal of the vehicle has been accounted for by adding back the cost, only the profit element needs to be, if you like. So key point is that if you have adjusted for this, then all you have to do is just add the profit element as well, right? And hopefully, again, like we'll see examples when we get to the exam kit. But that's the thinking. Right, okay, and that's another example. So please, you can do that. You can do that example as well on your own. So again, capital allowances we will come to. Capital allowances, we're going to come along and see them in the next chapter. We'll probably do this on Friday. Capital allowances, very important. And then we're going to talk a little bit about this short lease premium. But I've already talked about this from the point of view of the tenant, of the landlord, and we're going to expand on it now by doing an example. But the key point, this says we're going to talk about lease premiums, and of course you are allowed a business portion of running expenses if you're using your home as an office. If you like the business calls, of course, from a private phone, yes, of course. But the key point really here is we're talking about expenses that are wholly and exclusively for the business, right? So that's kind of the situation with that. And so first of all, with leases, I guess it pretty much makes sense that we do not. If you have a lease, you don't start. The amortizing of that lease is totally irrelevant. We add back all depreciation or amortization, add everything back. But you can, if you like, deduct this allowable proportion of the lease premium. And we've discussed this, but we'll see an example that discusses it again. Now we're coming from the point of view of a tenant. Yes. So here we have the scenario, right? If you remember how we did this. It says Laurie prepares accounts, and he paid a premium. This is what he paid. He paid a premium of 25,200 for a grant on a 21-year lease. So this 25,200 will break into two parts: a capital portion and an income portion, right? And that's, remember, we used our formula 51 minus n over 50 times that to give that. So that's the property element. So in effect, he has just paid his landlord 15,120 in rent, and he has also paid, if you like, the difference, which would be 25,200 minus 15,120, right? 0.9. So that's the capital element. We're not interested in this. This is what we're interested in because we're dealing with his trading expenses, right? So he's paid 15,000. Basically, he's paid his landlord 15,120 as an expense for rent for 21 years. Well, we're only really interested in it yearly, right? Because this is what I was saying earlier on, that the landlord would be deemed to have assumed all of this at once, which he has. But this tenant, for the accrual's sake, cannot put all of this through at once. This is for 21 years. So he must put through if you like, 15,120 divided by 21 each year. So he can deduct 720 each year. So I mean, the double entry isn't. It's just the fact that, if you like, he has something of an accrued income, so to speak. Laurie doesn't he? Because he's credit bank 15,120. He's paid the whole thing. So you must debit some kind of accrued income, and then you release from that accrued income into the income statement of expense of 720 each year. And that's that. So okay, yes, and that's that. Then we also have a scenario here where this person is using a room in their 5-bedroom house as an office. So, well, if he's using a room, then it sort of makes sense that utilities, right, spreads across the house. So a fifth of that can be used or can be classified as business. Yes. Television repairs, well, that's just television repairs, has nothing to do with the business. Groceries have nothing to do with the business. But the mortgage interest on the, this is a kind of interest payment. And yes, a fifth of this counts towards, if you like, his expenses, because he has to technically sort of pay rent, doesn't he, for this place. So let's just look at what they're doing here. So it says here that he uses one room, one fifth of the expenses that relate to running the house. The television repairs. Oops, television repairs. Oops, sorry. Almost there. 1 second. The television repairs. Did that come back up? Okay. So in your well, if you please, if you can, I'm sure, I don't know. I'm so far ahead of this video now. I'm sure I'll fix this problem. But it's back. The television repairs, and the groceries are of a private nature and therefore not deductible. So the total, if you like, are the mortgage and the utilities. And we really want a fifth of that. So if you look on page 212 of your textbook, right, you will see that what we're doing here is really, it's back. Good. So what we have here is that we are focusing just on those two items. That's the mortgage interest, and those are the utilities. And that's how we deal with this. Now the last bit in this, before I get you to do that question, if you can please, is that clearly we're happy with this idea of that if you end up putting in, because it's possible, gains on sale, you might put in your income statement. Well, that needs to come out, if you like. So any profit or gains on sale of any assets needs to come out. If you have any savings income, property income, any that sort of thing, it needs to come out. We're not saying we're not going to tax it, but not just within trading income. And you might have some income that's exempt from tax. You just need to watch out for it. But we talked about things like that, NS&I.